Welcome to Hustles University Lecture Extended Crypto Principles, a collection of short lessons on the nature of crypto investing. My name's Professor Adam, and we're going to be walking through a couple of little principles with you today. Preface: this research contained herein is a result of Professor Daniel's considerable experience and careful observation. I'm here to collect it and present it as close to the original form as possible. All credit goes to him for all this research here. So, contents. Understanding the nature of Bitcoin's behavior, why we use the Bitcoin daily chart. Being a good trader is like being a good fighter. The most profitable way to approach crypto. What to do when alts are dead forever. Finding the tops in markets. Simple ways to invest in a bull market. Why your projects need a moat. When it's too late to invest. Are we going to see another 90% decline? Hold on to your seats, guys. We're going to be covering all this stuff in the upcoming lecture. So starting out, understanding the nature of Bitcoin's behavior. Bitcoin's price action can be summed up in two distinct driving forces. On a longer time frame, Bitcoin's price is driven by investor activity and its adoption curve. The amount of users, how valuable Bitcoin is to use and to hold, as well as how developed the surrounding infrastructure is, gives Bitcoin an underlying price floor. Over a shorter period of time, price is determined by which direction can liquidate the most traders on derivatives exchanges like BitMEX and Bybit. Reflexivity is the best word to describe Bitcoin's behavior that marries these two principles together. Coined by George Soros, reflexivity is the theory that a two-way feedback loop exists in which investors' perceptions affect the market, which in turn changes investors' perceptions. Put simply, higher prices cause higher prices, and lower prices cause lower prices. You can see in this diagram down the bottom here that I have positive reflexivity. You guys will be most familiar with this one because this one's what happens during bull markets. The price goes up and Bitcoin is validated as an asset. So we see a flood of new users join, which of course leads to a greater network effect as everybody's telling each other about it, which means the price goes up some more. And this cycle continues to reinforce itself. But the same thing can happen over short periods of time. If we have the price go down, the asset itself is seen as not useful because, oh my god, it's suddenly not making me all the money that I was meant to make. Users leave and we have a reduced network effect. So you're probably wondering, at least initially, if this is the case, then why doesn't it just keep going up forever? Well, that's because of these liquidations that can happen over shorter time frames. You see, when people are investing in a bull market, they often get very excited and they start to use a lot of leverage. Typically, people use the most leverage at the top because they're idiots and their liquidation levels are very, very, very close to the current price, which means that if the price declines just a tiny little bit, then they are forced sellers of the market. This in turn causes the price to rapidly reverse, and that's what starts the negative reflexivity phase of the price action essentially. So you have rapid increases in the price, and then you have all the leverage at extreme points in the market caused by idiots, and then the liquidations cause them to be forced buyers and forced sellers in the opposing direction of the prevailing trend, which actually causes the rapid reversals. So, yes, why does this occur on the longer time frames? Bitcoin derives a significant portion of its valuation from its own network effects. So the network effects is the total number of users on the network. As the market is future looking, the market is collectively deciding what the future adoption of Bitcoin will look like. Because Bitcoin's main use case is its ability to make people money through speculation, at least that's how most people perceive it, it creates this two-way feedback loop. This is why we get massive run-ups and subsequent pullbacks. Reflexivity is like a snowball rolling down a hill. The bigger it gets, the further it goes. Except, like I mentioned before, it can go in both directions. The practical takeaway here is that Bitcoin can go through periods of extremely powerful momentum when kickstarted by a cascade of liquidations in one direction or another. So, anchoring your analysis on the Bitcoin daily chart every day. This is an important one because it covers the hierarchy of timeframes principle. If you trade Bitcoin, it is best to trade in line with the high time frame trend. Every day, you should first analyze the daily chart, or even higher if you want to, the 2-day or 3-day. I use the 3-day quite often now, and analyze where the price looks most likely to head. Is it bullish or bearish? Are we trending or are we ranging? This is paramount for your profitability. Once you have an idea of the overall trend, you can go into lower time frames, such as hourly, and enter positions in line with the broader trend. This is kind of like getting a tailwind. So personally, when I jump into the charts, you'll see me, or at least I will be jumping into the higher time frames. I'll be looking at the weekly or the 3-day chart, and then I'll go down into the daily or the 12-hour. And if I'm just looking to have a little bit of fun, I might go into the 1 hour or 4 hour and have a look around there for some action. I rarely do go down this low though. Most of what I do exists on the higher time frames because you'll actually find that there's an inverse relationship here between the probability of success, at least in my personal experience. Every person is different, of course, but my personal experience, I have found more profitability in the higher time frames, and just being patient rather than going down too low. The amount of energy required is it's not suitable for my personality type. So I stay up here where I find the highest probability of making money. So being a good trader is exactly like being a good fighter. You see, 99% of people overestimate their ability to fight by 100 times. 99% of people overestimate their ability to trade by 100 times. If you think that you can simply hop into a ring with a professional, throw a few punches and win, you are 100% wrong. The ring of a boxing match is exactly like the ring of the financial markets. You're competing against the world's best, and everyone wants blood. Trading is a skill set that takes dedication to master. The only reason why everyone isn't a full-time profitable trader is because they are psychologically weak. Imagine this: you see your friends becoming professional fighters. You want to be a pro fighter too, so you sign up for your first cage match against a trained pro. But all my friends did it, so can I, you say to yourself. Bam! You're on the floor, your face is fucked, and you wake up in the hospital. The truth is, 99% of your friends can't fight or trade. They just got lucky against an easy opponent. That's if they even get lucky at all. The other 1% that can are geniuses and spent years mastering their craft. Crypto is not simply an opportunity, it is a talent that needs to be developed over time, just like professional fighting. Take the quality and consistency of your education seriously. Learning to trade is important. Learn to trade like someone is trying to come and kill you, because in all honesty, they are. You start out as this motherfucker and you end up like this motherfucker. This is what happens when you don't take it seriously. And this is a tweet of mine that I quite liked. Day trading from your phone is like going into the ring with Andrew Tate with no mouth guard, no head protection, no body armor, and no training. It is suicide. You will get the results you deserve by not treating finance as a serious life or death endeavor. This is not something that you can approach just with a willy-nilly attitude. You have to absolutely be a savage. You have to want to be the best. You're here for a reason. Take the quality and consistency of your education very, very seriously. Okay, so the most profitable approach to crypto. When starting out, people look at their options: day trading, swing trading, long-term investing, farming and staking, like DeFi stuff, maybe even NFTs, whatever. And they think to themselves, man, I want to make the most money possible. I need to go into day trading, just like all those Forex influencers online. Long-term investing is too slow. Wrong mindset. It might be counterintuitive to you, but the most money is actually made by buying high upside projects on dips and just holding for the long run. I can vouch for this through principle and through experience personally. How the fuck do you think you're going to outperform a quality token going up 5,000% over like 1 or 2 years in a bull run by trading? It's not going to happen. Jumping in and out when all you have to do is wait, it's madness, honestly. The more you think about it, the more insane it gets. The only reason why you would pursue trading is simple. You want to have a method of making money when the market is occasionally in easy mode. And this is not trading. This is definitely ranging. Or at the beginning of a trend, perhaps, like maybe finding the optimal entry and then just leaving it the fuck alone. Uh, and maybe you enjoy sitting in front of charts for 8 hours a day, just staring at the computer. Or you already have some major capital invested in some high quality strategies over long periods of time and wish to explore some alternative methods of growing while the market is going sideways. Okay, so what about this question or this statement? Alts are dead and they will never pump again. This is only true if they're genuine garbage, and if they have good fundamentals, this simply means it's time to buy. Altcoins pump because humans are greedy. During the recovery, Bitcoin leads the rally first. It makes news headlines as it breaks old all-time highs, etc., etc. People get excited, but annoyed that they missed out the next big rally. As humans do, we go, well, what's the next big thing? What will that thing be? It's always altcoins. Doesn't matter if the coin is shit or good, though. As long as it seems legit to newcomers, you can basically piggyback off them and trade. Whether or not you can psychologically handle the knowledge that you're holding shit is that's a personal decision. Human nature won't ever change, honestly. Because of this, the cycle of alts are dead. They won't pump again. To buy alts for financial freedom, it's moon time, will never end. The point that I'm trying to get at is that as a trader or investor, your goal is to identify peak fear and peak greed. It's in these moments that you have the greatest opportunities. You need to buy when people are chanting that alts are dead, and you need to sell when people are chanting about how their grandparents are now buying shitcoins and they're all looking at the islands they're going to buy in the future. Okay, finding tops is harder than finding bottoms. When finding bottoms, there is historical context where you can identify a high probability buying opportunity. Additionally, there is always a minimum price investors will be willing to buy all of the available Bitcoin. And that's going to sound a bit like hyperbole, but I'm deadly serious. Like there is a floor price where literally there is infinite demand for Bitcoin. And this hyper demand zone is increasing over time. Clearly, it's invisible. You need to use on-chain analysis to determine where those levels are. It's not a strict science. You could imagine it as a zone, kind of like where you get hot and cold. And yeah, it's more like a principle that I have in my mind as a mental model. When finding tops, if a Bitcoin is making new all-time highs, really the only resistance levels that you can use are fib levels and psychological resistance levels like 69,000, 80,000, 100,000. Because there's no historical precedence for where the price is actually going. Like we're literally in, you'll hear this term thrown around, price discovery. This is where the price is trying to find where its next stopping point is. Price discovery is where you want to be fully long because things are going super parabolic. This is not a recommendation to FOMO into parabolic rallies, though. You know, ultimately, you want to be positioned beforehand like a professional. But yeah, this is something to think about. Selling tops is basically impossible, especially if Bitcoin is in a parabolic uptrend. The volatility is so insanely high in these moments that the intraday range could be as wide as like 50% or more. It gets absolutely bonkers. So focus on mass euphoria, ultimately, where you can strategically dollar cost average out of your positions for maximum gains over the course of like several days. If you can identify a window of maybe several days or maybe like a week or so, where you can dollar cost out of your positions related to, you know, the previous slide on mass psychology is still related. Observing market psychology is definitely the best tool that you can use for this. So yeah, look for the classic signs that BTC has peaked using some of the following ideas. Your Uber Eats delivery boys are becoming rich. Old people are looking to convert all of their traditional assets into cryptos. Retards are talking about quitting their job to trade full time. It's a classic one. Rapid clustering of celebrities promoting crypto projects. Often the celebrity thing, you'll see celebrities and there'll be a few of them on the way up that'll be promoting crypto projects, but it's really the clustering of these celebrities promoting crypto projects that you want to look at. Celebrities, man, are the worst traders. They're the fucking worst. I swear to God. If you're active on Twitter, if you're paying attention, man, you'll see it. Like they will just make the dumbest calls. KSI is a good example of this. Literally today, at time of recording, I saw a tweet from him yesterday saying, "I'm longing Bitcoin here. Wish me luck." And today, like, it's fucking down like 5%. Like, he's a retard, man. Cool. So simple ways to invest in a Bitcoin bull market. Moving averages are the most basic method, but can often give false signals. They're good though. They're good for general ideas. Here are some examples. The Bitcoin price itself is above the 200-day simple moving average, or your 50 DMA is above the 200 DMA. Now these DMAs, they can either be simple moving averages or they can be exponential moving averages. I prefer exponential moving averages, but you can choose what you like. Or you can have the price relative to key levels. If you have the price breaking up over a key level, that's a good example. I'll show you one a little bit later. So, however, keep in mind that there is no one single accepted way to determine if an asset is in a bull market. It's best to have many different methods and allocate a little bit of capital to each of them so that you have no one strategy that's going to be responsible for everything. So if you get a false signal, it's not going to destroy you. This is the method that I personally use to manage my portfolio. So here's ideas. Allocate 1/3 of the portfolio to price going above the 50 DMA. Allocate 1/3 to the moving averages crossing each other, and allocate 1/3 to the prices making a clean break above an important level. The more ideas, the better. Ultimately, you would want to have maybe, geez, the sky's the limit, but you'd probably want to have like 10 different ideas. That would be preferable. 10 different ideas, having them all operating at different things, different rules coming from different places, be creative and try and get them from different sources. Maybe have a couple of technical rules, have a couple of economic rules, have a couple of sentiment-based rules. This is the optimal way of doing it. So these three that I've given you here, a good place to start from intellectually, but do not take this as a direct recommendation of a strategy to deploy. Definitely use this, but like as a starting position for your research. Please do some additional research on this. Create a nice broad variety of different strategies to choose from. I go over some of these different ideas in my masterclass, but you can also do other research of your own. It's quite an exciting thing to do if you want to create a system that takes care of you later on. It requires very little energy to run at a later date, but you put in a lot of research at the beginning. That's an example. So let's look at two examples. Very quick ones. This is an example of a key level. This is back in late 2020 when we had the epic bull run. You can see that a previous break of the all-time high, even if you missed that initial break, even though it was you could kind of see it coming, you could have bought in this consolidation, or really at any point over here. Say you wanted to dollar cost average into your position, you could have bought a little bit each day, and your average price would have been just below these wicks somewhere maybe, and you would have still received like many multiples on your price there. Sorry, on your entry price, which would have been good for you. And this is an example of a moving average strategy. You can load up something like this on TradingView if you'd like. Moving average crossover strategy, just something basic. And this one's going back very, very long time. And these are the inputs. Exponential moving averages, just something rough like this. This is going to give you false signals a lot. Moving average strategies generally do give a lot of false signals. Like over here, for example, if you zoom in, I don't know what the quality of this video is going to come through like, but you can see it bought high and it sold low. That's an example of when it doesn't work. But if you're looking at big macro moves, you can see here, it sold, then we went down, then we bought, and then it went up. Same thing for these parabolic runs up here. Same thing for this parabolic run up here. And yeah, so that's an example of something that you can add to your strategies. Cool. So let's have a look at moats. So this moats equal value accrual. This is all about tokens and like altcoins and smaller projects that you want to look at when you're doing research. So moats equal value accrual, which equals defense from your enemies. So the best crypto investments are actually the projects who can create a moat around their business. This is good economics. Due to crypto being an open, permissionless, and borderless technological innovation, it's quite easy for copycat projects to come along, clone the code, and steal market share. And for speculators, there's no loyalty to a project if you're just going to make money somewhere else. So when you're considering this, it's like, oh my God, well, why doesn't the competition just completely eliminate all competitive advantages? Well, that's where the moat comes in. Take Tether, for example. At one stage, Tether was basically the entire stablecoin market. Then competitors came along and ate away at their dominance. The competitors were only slightly different, mostly being more regulated, but because of Tether's network effect, brand trust, and immense exchange trading pair integration. Also, they were first movers, so that's an important one as well. They moved very quickly, moved deep. This is their moat, and they were mostly able to sustain their position. So when you're looking at cryptocurrency projects, if you're compelled to do your own fundamental research, you must carefully assess whether they will have the ability to gain a special network effect or moat over its competitors. This is the only way that they're not going to go to zero. Okay, so let's ask the question, or people asking the question, is it too late to invest? You're asking me a question with no context. Tell me what your time horizon is, asshole. Do you think the price of Bitcoin will be higher than 4 years? Yes or no? Of course it will be. It's literally got bullishness built into the code. If you're a young guy with little savings and little responsibilities, then you need to go all in. Worst case scenario, you have no self-control and sell it all at the bottom like a dickhead and you're broke at 24. Who cares? Valuable lessons were learned because you acted like a retard. Best case, you make a fuck ton of money because you held, added money on major dumps, just like we recommend, and now you're set for the next big opportunity. The biggest difference between you and the average successful person isn't intelligence, social class, natural talent, or connections. It's the ability to bet big when the opportunity presents itself. Crypto will provide these buying opportunities on a long enough time horizon. You have to deal with the short and midterm price corrections. Yes, this is all part of the game, but they also are part of the opportunities. Bitcoin is bullish biased over a long time horizons, and the Fed isn't going to stop printing money anytime soon, which is fuel for Bitcoin going up if you don't follow economics. And the innovation is just getting started. Bet accordingly. And here you go. This is another thing that I should have added in here as well. Bet big when the opportunity presents itself. Guys, we have Daniel's Bitcoin hunting dip algorithm. You have no excuse not to be able to find the perfect buying opportunities over long enough time horizons. Of course, you need to use a little bit of discretion, just like any indicator, but Jesus Christ. And this isn't even me shilling because you guys get it for free. I don't give a fuck. But it is the most accurate tool that I've seen for buying bottoms. Obviously, it's not 100% accurate. No indicator is. It's like 95% accurate. And that's the best you're going to get. Use it. Okay, so comment on why we don't expect to see traditional 80 and 99% declines across the board during bear markets into the future. So consider this. In 2017, this is the altcoin space. 99% of altcoins are useless. The only demand for the tokens were from speculators. The inflation of new supply being created was super high. The teams were liquidating token treasuries to fund yacht parties. All the promises projects made for innovation were unfulfilled. Scammers took over many projects and were exposed as money grabs. It was absolutely atrocious time. I remember that. God damn, it was just the most terrifying time. Everything that you touched basically went to zero. In 2021, 2022, and into the future, this is the altcoin space. Tokens now accrue value. They actually lock value as part of the protocol dynamics. Many protocols actually offer product utility. They solve real problems. There is a greater alignment of incentives between the founders and the success of their protocols. I'm just going to go back one, actually. Many protocols accrue product utility. You got to use good judgment. Like back in 2017, like I remember all this shit. God damn it, they all came out with so many stupid ideas, and people were like, oh yeah, if only we could get the power grid of the entire world onto this one token, imagine all the money we could make. Like, are you fucking serious? Like, you float a token with an idea and a statement, and then nothing happens. And just like this last point, scammers take over the project, and and people just literally dumping on their token holders. It was absolutely atrocious. Sorry, quick rant. Token distribution improvements nowadays over the 2018 VC Insider pump and dump model. We have big lockups now, actually, that I've noticed a lot of VCs are having to adhere to, which of course is always good. Projects are developing moats and competitive advantages over other projects. So modern day project tokens have improved supply and demand dynamics as a result of all this. The demand side, crypto projects now have real and continuous demand for their tokens. The supply side dynamics of projects have great incentive alignment to support token holders. They've done a really good job at tightening up all this stuff. People are starting to realize that the old altcoin models don't work anymore because they literally just get destroyed into oblivion and nobody will buy them. They won't have the liquidity to fund their yacht parties, and everybody also has big bags of Bitcoin and stuff like this that they can liquidate if they want to have fun as well. But because, like we've mentioned before, this entire space is the most pure representation of a capitalistic market, people are going to be choosing teams that have their best interests in mind. I'm not going to be investing in a token that's going to dump on me. The fuck would I want to fund somebody else's life for? I want to make money. And we want to make money, which is why we only try and identify high quality tokens for you guys to invest in month after month. Very important. So, on summary, Bitcoin can go through extremely high momentum periods when kickstarted by liquidation cascades in either direction. Using the daily chart is a great way of figuring out where the prevailing direction is, so you can swim with the current when you're trading on shorter timeframes. Casuals in the market get killed. Treat crypto investing trading as a skill where if you get it wrong, you literally die. Then you'll stand a chance. When the market is undergoing a strong upwards trend, don't try and trade it by jumping in and out. You will underperform. Just go with the flow and get out at the macro top. Buy on max fear. Untrained people will always allow their emotions to guide their decisions. Sell on max euphoria. Look for social signs of insanity when all technical signals stop working. Using moving average crossover strategies or key resistance strategies allow you to allocate in bull markets using some simple rules. Carefully assess if a token will have the ability to gain a special network effect or a moat over its competitors in the market. It's never too late to invest if your expectations are well managed. Invest for the long run and fade the get-rich-quick mentality. Bear markets will be less brutal over time, but this might also mean pumps become less insane as well. Two sides of the same coin. We never know. Maybe we'll go hyperbolic and there'll be adoption all over the planet and we'll replace gold. It's still an opportunity. It's still a possibility. Don't discount that quite yet. Bitcoin volatility will decrease in both directions over time, so it's not as dangerous as it used to be. Cool. So covering all of those things, thank you so much for your time, guys, and appreciate your attention. Let's talk very soon. See ya. Hi there. Welcome to Advanced Philosophical Principles. My name is Professor Adam, and in this presentation, we're about to cover critical foundational lessons for investment management and skill deployment. I hope this will be a timeless lesson. I recommend you re-listen to this one and take notes as needed. Let's begin. Let me ask you a question. Did you recently miss out on an NFT mint or a coin pump you were really hoping to catch? Did you find yourself estimating the profit you'd make if only you could get that mint allocation? If only you could get the right coin? How high the NFT floor price might rise compared to similar projects? The large gains you might make if SHIB reaches parity with Doge. Perhaps you're thinking ADA might flip ETH if its superior coding language is recognized. Maybe XRP's SEC case will get dropped and it will moon harder than XLM. I think about these things sometimes as well, and I like to fantasize about the magnitude of the gains, more so how it would materially change my life though. Cars, travel, how I could afford to throw big sunset parties at my waterfront mansion before a night of clubbing with my friends. I am only human. It's quite exciting to imagine the possibilities. A few months ago, I was unable to secure 2 NFT mints that I really wanted and found myself feeling quite frustrated. But this feeling was fleeting as I reminded myself I am still likely one of the world's greatest investors and that I was merely relying on luck to get me an allocation. For me, 5 minutes of disappointment. For most of you, live your whole lives in this constant state of perpetual hope and misery. But why is there such a fundamental difference between me and you? When the NFT mint goes wrong, when the token gets rugged and all the toys go back inside the box, I simply return to my existing skill set and say, well, that was fun. Time to get back to work. Work that carefully, remorselessly, methodically, surgically cuts out any cancerous luck that exists in my systems. Most of you motherfuckers think aping into NFTs and shitcoins is your only chance of becoming wealthy because you're bringing the poor person mindset of gambling into my world of investing. Worse yet, you see this activity as entertainment. If you want entertainment, put your hand in a fucking blender. I have spent almost all of my energy in this university trying to convince students that investing is not about luck or just about getting rich. It's about getting rich for sure. Crypto is not just another lottery ticket in the form of digital memes. It is a business opportunity. Do you understand? Almost 100% of the students coming into crypto are in a permanent state of scarcity-induced fear. For most of this is the indirect fear of loss, which is the most insidious type. With this particular fear, people try to convince themselves that they have already lost the money so that they don't have to deal with the emotional pain of impending loss, which is where the gambling mindset comes from. You'll often hear people say things like, I have $1,000 and I'm ready to bet on some high gain potential tokens. 10x would be nice. In their mind, they have already convinced themselves they will lose the money, not because they don't want the money, but because they are afraid of loss and want to relieve themselves of this feeling and replace it with the dopamine rush of hope. Well, fuck hope. As professionals, we do not gamble and we do not hope. Research, hard work, and self-control are the keys to success. Either put in no money at all or put in your entire life savings so that you're forced to act like a professional for once in your life and take something seriously. Gambling is poisonous to the mind. It is a way of convincing yourself it is okay to lose money. It's never okay to lose money. It never was. I'm talking to you. Yes, you, the one listening to me right now. Never, ever gamble on any investments again for the rest of your life. If you don't have an unfair advantage, you should not invest. So what about the direct fear of losing? People afraid to lose panic with every tiny move in the market. Trading without this fear of loss needs to be cultivated like a skill. The best traders embrace the fact that not 100% of trades will be winners. Only professionals are at peace with this fact. Peasants live in such crushing scarcity that they only feel safe trading if they are promised a 100% hit rate. When they can't get that guarantee, they change the rules in a panic, the very rules which were designed to protect them. Understand this: changing a working strategy in a fearful attempt to avoid the unavoidable guarantees annihilation. Stick to the strategy. If the strategy doesn't work, close all your positions, come back the next day, and rewrite your entire strategy logically. Trading must be an emotionally frictionless experience. Trade not working? Exit instantly. No remorse, no other thoughts, no hesitation. This comes from an acceptance of the reality of how market randomness works at an instinctual level. If you cannot handle uncertainty, you'll live your life in fear forever. You'll have to stay at your day job like a good slave, receiving your fixed salary week after week. You'll never be afraid, but you'll never reach glory either. Direct fear of loss can come from feeling like you cannot trust the market. The truth is, the market is a killing machine, and you can absolutely trust it to do what it does best, which is to exploit underprepared people. Upon this reflection, it should be clear that it is yourself you cannot trust. Casuals cannot be trusted to do the research. Casuals cannot be trusted to form a plan or a strategy. Casuals cannot be trusted to execute a strategy with a proven edge consistently. Want to know how to instantly upgrade from casual to professional? Professionals know the secret of winning in the market over time. That is that no trade matters. Yes, you heard that right, dear viewer. No individual trade matters. not by itself. It's really the next 20, 50, 100 trades or investments that accumulate towards success, like the habits that allow you to eat healthy or go to the gym. If you've ever actively formed a habit, you'll know what it takes to condition yourself in this way. We've already spoken about how there are no certain returns in the market. Therefore, it is the accumulation of many trades which lead to a high return. Winning trade, losing trade. We go up and down and we never know what the next trade might bring. And that's okay. That's how it's meant to be. Provided you make consistent, positive, expected value choices with a sound strategy, eventually you're going to be exposed to positive price appreciation. And only once you understand this, you'll make all the money you ever wanted. Can you surrender your ego to the rules that you've created for this purpose? These golden chains of profitability, known as rules which restrict our freedoms. Our ego wants to be smart and insightful and to be free of these rules so that we can make our own investing choices based on what we perceive to be the wisdom of our untrained instincts, which we are quick to forget are more aptly designed to throw rocks at wild animals than to make complex probabilistic statistical calculations on demand. Our ego wants to be able to claim, I saw this profitable trade coming because I am so smart. We want to be able to gloat and feel proud of our intellect. We want to tell our friends, our workmates, and our family. Meanwhile, the professional quietly claims to himself, I know nothing. It is the rules I created that told me what to do. We fall victim to the ego because we forget our 400,000-year-old caveman minds are still and have always been in charge of our choices. The rules, systems, and principles which most are so eager to disregard are the very things you must embrace with eyes and arms wide open to prevent the self-sabotage which is ingrained into our nature. A great example of this is our desire for revenge, our obsession with a past course of action which we have taken. Tempted to ask what the correct action is in terms of their entry price, students overlook the fundamental truth that their entry price is utterly useless and an irrelevant piece of information for all decisions. In chess, the only thing that matters is the current position and the time on the clock. Why would this be any different? You cannot go backwards through time. No one cares if your entry was $100 or $100,000. Your current position is all that matters. The rest is emotional garbage. What price you got in at shouldn't affect whether you exit a position or not. It's all based on one question alone. Does your research show it going up or down from here? At the end of the day, humans didn't evolve to sit in front of a screen and make complex expected value judgments or statistical probability calculations. What we were meant to do was punch kangaroos, jump on the backs of crocodiles, and get out of the way of flying spears, which is why the emotional disconnection afforded by a well-researched rule set is so powerful to us as investors. The sooner you develop your rules and strategies using the materials within these holes, the better. With all this being said, how does one manage themselves? Take note, friends. The principles of both your strategies and mindsets are as follows. Regarding the mind, anything can happen, so be at peace with the chaos. The market is a killing machine. The market is a mirror. It reveals a man's character to himself. Master the man within. Master the market. You don't need to know what's going to happen next in order to make money. This is the strategy. There is a random distribution of wins and losses for any given strategy. You understand the absolute necessity of the principles and rules to success, and therefore you never violate them. Every moment in the market is unique. Never blame the market. The market cannot betray you. It simply exists. The market is always right. Don't swing wildly from joy to fear, greed to guilt, hope to despondence. Feel nothing. There is no shortcut to becoming emotionless in practice. It is a complex mixture of deep understanding, instinctive appreciation for randomness, mental exhaustion over time, and meditation. Regarding strategy, the true currency of any market is not dollars, it's probabilities. Your strategy is nothing more than a higher probability of your desired outcome happening over another. There is never a guarantee for any individual trade. You develop the rules, and the rules define the trade execution. There is no direct link between you and the trade. The rules always sit between you and the market to dictate your actions. It is a gatekeeper. You must identify and predefine the risk on every trade, position, or portfolio segment. You must completely accept and be at peace with this risk you expose yourself to. You act on your strategies without reservation or hesitation. You pay yourself as the market makes money available to you. You continually monitor your susceptibility for making errors, both intellectually and psychologically. Beware the sunk cost fallacy. Remember, entry price is nothing more than an emotional connection. The only thing that matters is if the price will go up or down from here. With that, thank you for your time, friends. Talk to you very soon.